The global credit freeze has definitely thawed, but it's still tough for many companies to raise money. So what are their options? Well, one is called PIPES. It stands for Private Investments in Public Equity, and more companies are actually using it. And Sheila Dharmarajan explains why. Sheila?
Hey there, Betty. So Kodak, Whole Foods, Office Depot, all examples of companies that have had PIPE investments lately. It's a trend we're seeing more and more of, so we wanted to give you the 101. PIPEs, what are they? Well, they stand for Private Investments in Public Equity. So what happens is when a company can't access the debt or equity markets for financing, they turn to private investors for the cash. Who are these investors? Well, think accredited investors, so private equity funds, hedge funds. A lot of those guys have been playing heavily in the PIPE market lately. And the last point about PIPEs is there's no standard structure around it. So you can see a variety of forms of PIPEs, anything from buying the stock at a straight-up discount to the market price to more structured PIPEs, so think convertible debt or preferred equity. Lots of different forms of PIPEs out there. But the one thing for sure is that PIPE activity is on the rise. When you look at the data this year, PIPE activity has really been on a kicker. If you look at the last 6 months of the year, $27 billion in PIPEs raised versus the first 3 months of the year, only about $3.6 billion. That's 9 times the activity that we've been seeing in these past 6 months. So PIPEs are on a roll, Betty.
So why are they on a roll? I mean, why the sudden increase then, Sheila?
You know, a couple of themes are going on here. The first one is because there's a lot of debt coming due. It's a topic we've talked about over and over again, but there is a wall of debt that is coming due in the future. Companies took on record amounts of debt in 2006 and 2007, and at some point, they have to pay that debt back. It's going to come due. So if you can't access these financing markets, one way to potentially repay that debt or refinance that debt is through a PIPE market. Now, another theme that's playing in here is private equity. Private equity companies have had a tough time doing full leverage buyouts lately. The leverage markets have been choppy, so this is a way for them to still put money to work. But there are a couple of red flags about PIPEs. It's not all kind of fun and fancy financing here. The one thing is that it's a very, very expensive form of capital. Remember, companies are strapped for cash. They can't access the public market, so they're going to pay a price for that money. KKR Kodak deal, for example. KKR's cost of financing, 10 to 11%. Kodak's pre-PIPE financing, 5 to 6%. You know, the other point I want to make about PIPEs is that there is a phenomenon called the debt spiral. This is where investors short the stock to try and get more of the company. So some things to watch out for when it does come to PIPEs.